Okay, so let's go into lesson 4, importance of time and risk management. After this video and this lesson, you should be ready to go to play some demo trades without any confusion. Okay? Do you have any questions before we start?
I do not.
Okay, let's get right into it. So, time and price. In trading, the time of day matters depending on the different assets you're trading. So, different assets have different windows of volatility. For example, Nasdaq, which is the one we're going to be trading, it's most volatile during New York Open, which is from 9:30 to 10:30 New York time. This is going to be our focus. Okay, this is the hour that I trade, and this is the hour that you're going to be trading. Okay,
Yeah.
and to give another example, for example, Euro USD, it moves best during the London session, which is from 3 a.m. to 5 a.m. New York time, because it's a European asset class. Okay.
Yeah.
And why this matters is mainly to avoid dead zones, to avoid time where, for example, the Nasdaq is not moving or is just consolidating. Do you understand? Because
Yeah.
most of the time, these assets are going to be in consolidation. So you want to pick the time where it's the most volatile and trending.
Yeah.
Okay. And this right here is very important, which is price levels mean absolutely nothing without context. So all your key levels, everything, the fair value gaps, your liquidity, they're completely invalid if they're not aligned with the correct time. So for example,
Yeah.
if you trade Nasdaq during Asia session, none of this is going to be important. It's like guesswork. You're just gambling at that point. Okay? Because these key levels, they need to be put in the right time context. So you have to wait for the confluence of price plus time, which will give you the highest probability setups. And that's why we simply wait for 9:30 to 10:30 a.m. New York time. And that's basically going to be your trading session. You're not going to be trading outside this zone. Okay?
Yeah.
Do you have any questions regarding this?
No, I don't.
Okay, yeah. It's very straightforward. Now, another thing regarding time and price, it is how to use the economic calendar. It will take time for you to fully understand. There are many nuances within this, but I'll try to simplify it. So, in the economic calendar, you have high impact news, which are the red folder news. Okay, so let me show you right here. This is Forex Factory. All of these red folder news, they are high impact news, so they will cause lots of volatility. But not
Yeah.
every single one of them. We don't really have to pay attention to every single one of them. There's something called the big three, which is basically CPI, NFP, and FOMC. These are the big three, and these are the ones that you really have to be aware of. Everything else, whatever someone might tell you, because there are many people saying everything else is important, you have to pay attention to all of the news, red folder news. It's all bullshit. These are the main
Yeah.
ones you have to pay attention to, and they are the ones that cause the most of the volatility in the markets. Okay, so
Yeah.
they're basically volatility catalysts. Okay, for example,
Yeah.
last week we had both FOMC and NFP, non-farm employment change. Okay, for example, this
Yeah.
week was a very volatile week, and I'll show it to you in the charts once we get to it.
Mm.
So usually before the news, price often consolidates or chops around. I'm talking about the big three. Everything else is noise, like I said. So these big three, before the news, price often consolidates. So if you have any of these three in a given week, price is likely to consolidate before them, and it will give you low probability conditions.
Yeah.
During the news, spreads widen and slippage kicks in. So you should not be trading during the news release itself. Okay?
Yeah.
Here, if you trade here, I don't know, maybe you've seen some people, they place a trade right on CPR or FOMC, they go like full gamble on these news events. It's basically gambling, okay? Your odds are
Yeah.
better at the casino. So, because your stop loss will not work if you, let's say, you risk $100 and it hits your stop loss, you probably might lose $1,000 because the spreads widen, okay,
Yeah.
and the slippage because of the spreads and the slippage. So your stops will not get tagged out at the where you want them to get tagged out.
Is
Okay,
the spread because the market is moving like too fast?
exactly. And regarding this, the cleanest trades often comes after the release. So once the market has released these events, that's when you'll have the highest probability conditions.
Yeah.
So you can use the news to avoid danger, but also to time the week. For example, if major news is on Wednesday, expect Monday and Tuesday to be consolidating. And I'll show you, this is how it literally was like last week. I'll show it to you in the chart soon.
Yeah.
And yeah, the news set the tone for which days will trend and which days won't. So for example, let's say you're on a Sunday, you see next week we have FOMC on Wednesday. You understand that Monday and Tuesday are going to be consolidating, so you're not going to be looking to take trades that are going to be trending. Okay, you're going to maybe you can trade the consolidation, but you have to be aware of this. It's very important.
Yeah.
So you always have to check the calendar, the time of release, the assets that's going to be impacted, and the volatility rating, which is the red folder, medium, or low. As I said, the red folder doesn't mean shit unless it's the big three, according to me at least. Some people they pay more attention to it, some don't. Okay,
Yeah.
and yeah, I'll show it to you right now how it impacted the week. Here we had on Wednesday, we had many big red folder news events, but the main one was FOMC statement and FOMC press conference. Okay,
Yeah.
now
Yeah.
if we go into the chart, this was FOMC day, so I didn't trade here because I know it's going to be consolidating until the news release. So the news release was around this time, right here. Look how price instantly moved very quickly. You see?
Yeah.
Uh, while before it, we were simply just consolidating. We're moving up here, up here, down, up. You see, we were in a range. We were hitting key
Yeah.
levels, but nothing was happening. Key levels again, nothing was happening. We're just in a. This is called seek and destroy. We're just moving from one side of liquidity to the other, and again, and back and forth, continuing. So this was
Yeah.
during the day itself. Now, if you look during the week itself, so let's go to the week. You can see right here, this was Monday. Look how small Monday is. Look at Tuesday.
Yeah.
They're both just consolidating. And then Wednesday made a big move, Thursday made a bigger move, and Friday made another big move. Friday was also NFP. So
Yeah.
it was another red folder event. You see?
Yeah.
So Monday, Tuesday were consolidating, Wednesday consolidating until the news event, and then Thursday and Friday we had a clean price action.
Yeah.
So this is how you use the economic calendar to your advantage. And you have to be really aware of it. Okay?
Yeah.
Now let's move into some risk management. So how much should you risk per trade? A general rule is to risk 1 to 2% per trade, which basically, let's say you're trading on your a live account, your actual money, then you would have to lose 100 trades in a row to lose your full account.
Yeah.
So this rule keeps you alive.
Yeah.
A beginner rule, and this is what we're going to be doing, since as well you're going to be trading on a prop firm, you only have 10% drawdown. You're only going to be risking 0.25% per trade. It's much
Yeah.
lower risk. It will give you much more breathing room while you build consistency, and it will also keep you alive, keep you in the game long enough to learn and adapt.
Yeah.
And another rule regarding risk management and how much you should be risking is to always define the risk before entry. Obviously, this is a point where many beginners skip over, but it should be a no-brainer to have this in place. So you always define the risk before entry based on your stop loss and position size. And
Yeah.
you're not going to be adjusting it mid-trade or changing your rules around mid-trade. You need to have a plan, a risk management plan, and follow the plan.
Yeah.
You should also define the risk per day and profit per day. So I'll give you an example right here. You should stop for the day after 2 losses, or 1 win, or 1 loss and 1 win.
Yeah.
So this means that you only look for the highest probability setups. You only risk, let's say if you're risking 0.25% per trade, you're only going to be risking 0.5% for the day. You need 20 losing days to lose the 10% prop firm risk.
Yeah.
And obviously, if you get 1 win, you stop for the day because you've won and you don't need to risk anymore. You've already made a profit. You don't need to be greedy and continue. Okay? And if you lose the first trade and you win the second, you stop.
Yeah.
And I've realized this in my own trading as well. It's like the more you trade on a given day, the more probability you will be losing. Like you're just increasing your risk and mental capacity and everything. Like you'll be drained if you trade more than this.
Yeah.
But for you specifically, when you're going to be trading, I just want you to take 1 trade a day. I don't want you to take two trades, only one trade, and from there we'll build onto it.
Yeah.
Do you have any questions so far regarding all of this?
It seems pretty straightforward so far. Nothing really confusing.
Okay. It will get confusing once you actually start applying this, but
Yeah,
it's good
probably.
you're understanding so far. Now, risk to reward. I think you already know what risk to reward is, but
Yeah.
I'll give you more details. So, risk to reward, basically, you have to think in R value, and not in dollars. So,
Yeah.
example, you're risking $100 to make 300. That's a 1 to 3 risk to reward. Your 1R is $100 and 3R is $300. You have
Yeah.
to define your R before the trade. So for you, in your case, you're going to be risking 0.25%. That's your 1R.
Yeah.
Okay. And now the higher risk to reward, the lower hit rate, which basically means there's a lower chance of your TP hitting. The more risk to reward you have, the lower chance of your take profit hitting. So
Yeah.
price has to move further to hit your TP. Basically,
Yeah.
here is a chart showing what you need to have a break even.
Yeah.
I mean, the win rate you need to be break even. So if you're risking one R and you're targeting 0.5 R, that means you need a 67% win rate to be break even. So you need like a 70-80% win rate to even be profitable with this risk to reward.
Yeah.
If you move on to a 1-to-1, if you're risking 1-to-1, so you're risking 1 R to make 1 R, you only need 50% to be break even. So you need just slightly above 50% to be profitable.
Yeah.
Are you following so far?
Yeah. Yeah.
Now, if we move into 1-to-2, if you're risking 1R to make 2R, you need 33% to be break even. 33% win rate to be break even. So you need above 33% to be profitable with this.
Yeah.
You're following?
Yeah. Yeah. I understand.
Okay. Yeah. So the lower risk to reward, the higher hit rate. So a
Yeah.
1-to-1 needs just 50% win rate to break even, just like I mentioned here. And we're gonna be starting with a 1-to-1 risk to reward because it's gonna be easier execution, faster learning, and less pressure. You will realize
Yeah.
what I mean once you actually start trading. But because if you're trying to aim for more, you're gonna like psych yourself out of the trade. You're gonna want to close faster, etc. It will you'll have many emotions when trading. So this is mainly for the emotional side of things.
Yeah.
And once you're consistent with a 1-to-1, we'll be able to scale this up easily without even ruining your win rate. It's basically we're going to
Yeah.
be reviewing your trades, see if you can target more or not.
Yeah.
And now let's move into the fun part. Why 90% of traders fail? It's
Yeah.
really straightforward why 90% of traders fail, but yet many people still don't follow any of this. So, very simply, they don't have any risk management. They're risking too much on a single trade, or they don't have a plan regarding risk. They're just risking whatever they feel like on the day. Do
Yeah.
you see how that can be problematic?
Yeah.
They're chasing losses, revenge trading after a loss. They don't have an edge. They trade randomly. They don't have a plan. They haven't backtested their strategy. They're emotional. They focus only on price, ignoring time and context. So, for example, even for me, when I started out, when I was a dumb idiot trading, I was trading like any random time whenever I feel like it. I didn't have a plan, etc. I was basically following every point here I was making when I was unprofitable, and I was it's like wondering why I'm not profitable. You have to follow every single thing here to actually become profitable.
Yeah.
And this is the most important one. They don't have any data and they don't have any feedback. So they don't journal, they don't review, and never improve. Same mistakes, different day. You need to have a trading journal. You need to review every single trade you make. Do you
Yeah.
understand? You wanna have feedback. You wanna have data. How's your strategy performing? Are you following your plan? Etc. Etc. Okay?
Yeah.
And simple solution to this, we're gonna avoid all of these by simply having a rule-based strategy. So you're not gonna be guessing and trading whenever you feel like it. We're gonna have a simple rule-based strategy. We're going to have fixed risk per trade, especially in the beginning. And this is basically to stay alive and stay in control and continue stay in the game for a long time. You're not going to be
Yeah.
gambling your prop firm challenge within the first week. You're going to keep it for a long
Yeah.
time. And they only trade when it matters or when their setup is there. So you're only going to be trading when your simple rule-based strategy aligns. So time plus context. You're going to track everything. You're going to track every single trade you make. You're going to journal, and we're going to improve with data. So not just our opinions. Okay, we're going to see that what the data is actually telling us. Okay?
Yeah.
And the biggest thing, obviously, discipline over dopamine. Follow the plan, not the urge. It's very straightforward.
Yeah.
And this, everyone knows this. This can be applied to anything. Consistency beats perfection. Okay?
Yeah.
And that was really all for lesson 4. And after this, you should be ready to put some trades, get a feel for the market. Do you have any questions so
Yeah.
far? Okay. Now,
This
for the
all seems
homework.
very straightforward
Yeah,
so far.
exactly. For your homework, I just want you to watch simple videos on risk management for prop firms. And I want you to see watch videos on how time affects price. I've already told you most of the basics, but you should maybe watch some more, get more feel for it regarding these two. I've already went over them, but why not double down on them? Okay.
Yeah.
And now the fun part comes in. You're going to be trading every day this week at 9:30 with the FTMO free trial. So you're going to make a FTMO free trial. You're going to trade every day this week at 9:30. This is not
Yeah.
you're not going to be following a strategy. You're just going to get a feel for the market before we start applying rules and a system.
Yeah.
After with the next lesson that's going to come up, we're going to give you a system to actually follow. But now you're just going to trade. You're just going to get a feel for the market.
Yeah.
And I want you to be risking a set amount. So you're gonna have a. I want you to make a free trial with a 10K account, and risk 0.5% on each trade. So $50. Okay.
Yes.
Now I'm gonna be trading this week. Obviously, I want you to watch me trade live, which you're gonna do tomorrow or the day after. And I want you to note down the key points of this lesson and from the videos you'll watch.
Yeah.
And that's really it.
All
How
right.
do you feel? You ready?
I'm ready.
My guy. So yeah, that was all for today's lesson. In the next lesson, we'll go through a strategy and how to actually develop a strategy.
Yeah.
Safe. Do you guys want to have access to the documents featured in the YouTube videos? Click the second link in the description to join our free Discord community where you will get access to the documents plus a variety of resources to help you on your trading journey.